Hello everyone. Today we are beginning an essential chapter for every startup: investment, finance and the legal aspects. My name is Tetiana Topolnytska. I am an associate professor at Vasyl Stefanyk Carpathian National University, and this lecture opens a new module focused on helping you navigate how and when to attract investors, how to build financial awareness, and what to consider in legal agreements. Our goal is to offer a clear and practical framework, one that will support you in making informed decisions about investment and collaboration. Before we dive in, let me highlight an important note. This course is based on practical experience, expert interpretation, and real examples designed to support your startup journey. However, the views and ideas expressed reflect the author's personal perspective and approach to the topic. Now, imagine you're preparing for a serious climb. Your startup is the route. Your team, the people climbing with you. You've already left base camp. You have initial results, a plan, and discipline. But the next stretch is harder. It requires a partner. Not a rescuer, but a belayer. Someone who helps you move through risky parts with greater skills and awareness. In our context, that's the investor. But for an investor to truly help, you need to understand the rules of the game. When to find resources, whom to partner with, and what exactly to show to those who can support you. In this block, we will focus on the foundation of startup investing. You'll learn what makes this type of investments unique, when it's actually reasonable to seek outside capital, and when it's wiser to focus on internal growth. We'll explore who investors are, how they differ, and how to find the right fit for your stage and model. We'll also break down what fundraising really is and why it's much more than just asking for money. And of course, we'll zoom in on one of your most important tools, the pitch deck. You'll understand what investors are looking for, what captures their attention, and what common mistakes ruin deals before your team has even had a chance to show its true potential. This entire section is about preparing for the climb. And the first step is to chart the route, to assess your readiness for investment. Let's start with the foundation, assessing whether your startup is truly ready for external funding. It may seem like investment always means growth and opportunity, but in reality, outside money also brings responsibilities, expectations, and often a shift in pace and culture. That's why it's essential to ask yourself honestly, why do we need an investor now? And what exactly do we plan to change or scale with their help? In this chapter, we'll clarify what real investment readiness means. We'll look at internal signs that signal your company is ready for a partnership and the risks of bringing in money too early. It's not about flashy slides. It's about honest self-diagnosis. Is your startup ready for an outside partner and everything that comes with it? It's talent that makes the difference. This is not just a loud phrase. It's a principle that the best investors follow. Danny Riemer, a partner at the venture capital firm Index Ventures, once said, "We'll always back an exceptional team in a weak market rather than the other way around." Why is this important? Because startup investment is not about guarantees, it's about trust. Trust in people who can create value even in tough conditions. Markets can shift, technologies can become outdated, but a team that knows how to adapt remains the most valuable asset of any project. Remember, at the heart of every investment, there is not just an idea. There is you as a founder and your team. Startup investment isn't just about funding. It's about partnership, one that comes with both risk and growth potential. In this process, the investor provides financial resources to the founder or startup team. In return, they receive an ownership stake in the business. This means the investor isn't buying a product or ordering a service, they become a co-owner, and their profit is never guaranteed. They only earn if the startup grows, becomes profitable, is acquired by another company, or goes public. These are high-risk investments, but that's precisely why they offer great opportunities for both sides. Startup investing is not the same as investing in an established company. Here, the investor isn't buying a ready business. They are betting on potential and a team capable of executing a breakthrough idea. Here are 5 essential aspects to understand. High risk. Success is not guaranteed. Most early-stage startups may pivot or fail. High potential return. If a startup succeeds, the investor's profit can exceed the original investment many times over. Team and flexibility matter most. Investors care not only about the idea or product, but also about whether the team can adapt and find a viable model. Scalability is the goal. Startups aim not for stability but for expansion, entering large markets or transforming industries. Delayed return. Investors don't expect quick profits. In startups, the payback cycle often takes the years. These 5 traits form the foundation for realistically assessing both the risks and opportunities of startup investment. Before you start looking for an investor, pause. Take a deep look at your business from the inside. Ask yourself a few honest questions. The answers may save you time, energy, and focus. First, What is my goal? What do I want to raise investment? Is it truly about growth and scaling, or is it an attempt to patch the holes in a business model that doesn't work? Second, can I really not move forward without external funding? Maybe the solution lies in shifting focus, increasing profitability, optimizing expenses, or finding strategic partners. Third, am I ready to share equity and responsibility? Because investment isn't a gift, it's a partnership. You are giving away a part of your company and agreeing to play by new rules. These questions might seem simple, but they define whether you are truly ready to raise funds or whether it's better to first build internal stability. Now, let's look at some typical situations when raising investments might actually be appropriate. What matters is not just the need for money, but a clear understanding of why you need it and how it will help shift your growth trajectory. Scenario 1. You need resources to build the product. This is common in hardware, medical tech, or biotech, where progress is impossible without prototyping or lab infrastructure. Scenario 2. You already have traction, users, demand, maybe even early revenue, but scaling further isn't possible without additional resources. In this case, investment can help accelerate growth. Scenario 3. You are under competitive pressure. If delay means losing market share, users, or your niche, raising funds could be a strategic necessity. Scenario 4. You are entering an accelerator or already in talks with a potential investor. This is a window of opportunity. It's a chance to gain not just money, but also experience, networks, and knowledge. In all these cases, investment is not just about capital. It's about speed, support, and stepping up to the next level of growth. At the same time, it's equally important to know when raising investment is premature or even harmful. First, if you haven't tested your idea in the market, if there is no validation or clear demand, you are not ready. Second, if your team isn't in place, no roles, responsibilities, or processes, an investor won't build your team for you. Third, if you don't know how you'll make money, without a business model, it's nearly impossible to convince someone to invest. Fourth, if your pitch sounds like "give us money so we can think," or "we might try something," that's not investment ready. That's still the idea stage. Better to focus on internal development first. Let's try a quick readiness test. Imagine an investor walks in today and says, "Okay, I am ready to invest $50,000 in your startup. What exactly will you spend it on?" Can you answer already, with numbers, with a plan, and with a team ready to execute it? If yes, you are probably close to investment readiness. If not, that's okay too. It just means you need to prepare the ground. Work on your business model, financial plan, and internal structure. So next time you won't be caught off guard. So let's summarize. First, not every startup needs investment, and definitely not right away. The reality is that many startups can grow on their own revenue through early customers or with the help of grants. Bringing in an investor is not the only and not always the best path. Second, investment is responsibility, not just opportunity. Getting funding means obligations to your partners, regular reporting, result expectations, and shared strategic control. An investor becomes a co-owner, not a donor. And finally, the key question is your team ready to bring in external capital, use it effectively, and share control? That's a fundamental test of your maturity as founders, and the answer must be honest, especially to yourselves. Now that we've unpacked the question of investment readiness, it's time to dive into the next stage: how to find, attract, and convince an investor. In this section, we'll focus on three key elements: who investors are and how they differ from each other, how fundraising works and what to know before starting a campaign, how to prepare a strong pitch deck that grabs an investor's attention and highlights your project's strengths. This is a practical model. We are moving from internal clarity to external action, from do we need this to how do we do it well. So, who are investors, and how do you know which ones make sense for you to work with? In this simplest definition, investors are those who invest money in exchange for a share in the company. These are individuals or organizations who put money into your startup expecting to make a profit in the future. But in the startup ecosystem, the role of an investor is deeper. They can become your partners, provide mentorship, contacts, and help with scaling. That's why it's important not just to raise money, but to find the right investor. Someone who understands your industry, someone who believes in your model, and someone who works with projects at the stage yours is in. You should look for an investor not where the money is, but where there is interest in solutions like yours. And next, we'll look at how to understand who's right for you and how to build a relationship with them. Let's move on to the types of investors a startup can interact with at different stages. The first level is 3F: friends, family, and so-called fools. those who believe in you even before any results appear. They give small amounts, a few hundred or a few $1,000, but the most important thing is their support. At the same time, you should be careful. Agreement with close ones are often informal, and in case of failure, personal conflicts may arise. The second type is business angels. These are private investors with business experience. They can invest from $10,000 to $500,000, but their value is not just in the money. Angels often become mentors, share contacts, and give advice. At the same time, working with them requires a high level of trust, as these are usually individual agreements. Next, venture funds. They work with larger checks, from $500,000 to several $1 million. These are professional players who bring not only capital, but also scaling, strategic support, and access to new markets. However, they have high demands and usually require some control. Another format, accelerators and incubators. They can provide small investment, up to $100,000, but the main thing is their development programs. You gain access to mentors, training, community, and potential partners. The downside is the limited amount of funding and the very intensive schedule of their program. And finally, corporate investors. These are large companies interested in your innovations. They can invest large sums, give you a market to test your product, or even integrate you into their business. However, it's worth noting that deals with corporations are often complex, and excessive integration may cost you your independence. This is the main range of players you can interact with. On the next slide, we'll look at how to choose the one that suits you. Choosing an investor is not just about finding someone with money. It's about choosing a partner with whom you will build the company together. The first criterion is the size and type of funding needed. For some, a few tens of thousands of dollars are enough to create an MVP and test hypotheses. Others may need $1 million for scaling. This determines what type of investor you can even work with. The second criterion is the network and expertise the investor brings. If it's a person or fund that has access to your market, can introduce you to clients, partners, or future investors, this is a huge added value, which is often even more important than the money itself. The third is the style of interaction. Some investors want to be active participants. Others leave founders autonomous. You need to understand which format you will be comfortable working with. And lastly, time horizon and expectations. Is the investor ready to wait 5-7 years until exit? or does he expect a quick return? These things should be discussed at the beginning, so there are no disappointments along the way. By choosing an investor, you are essentially choosing a new co-founder, and this decision must be conscious. Let's start at the typical mistakes that founders often make when choosing an investor, and which usually cost a lot. The first is attracting an investor just in case. This logic often looks like, well, if we have an investor, it'll be better. But without a clear need, without a plan for using the funds, investment turns into ballast, not a resource for growth. The second mistake is informal and not transparent agreements with close ones. Money from friends or family, it's not just support. It's the beginning of cooperation. And if everything is not discussed in advance, it becomes very difficult to separate the personal and the business later. The third is idealizing large funds. It may seem that if a big player joins, everything will take off. But big funds come with big obligations, high expectations, and often interference in internal processes. Such cooperation can become both a catalyst and a source of constant tension. And finally, ignoring the cooperation strategy. An investor is not only about money. It's a partner with whom you move forward. If roles, communication mechanism, and level of involvement are not defined, there will be a lot of misunderstandings. That's why the cooperation strategy must be discussed even before the agreement is signed. Once you've defined what type of investor suits you, the next task is to understand how to communicate with them properly. And here we move on to the key process, fundraising. Fundraising is not just about raising money. It's about trust, partnership, and a shared vision of the future. Successful founders don't ask for money. They offer the investor an opportunity to join a project with potential. It's a structured process that requires preparation, strategy, and consistency. So, let's fix 3 principles that help to think of fundraising strategically. First, we don't ask for money, we offer a partnership. An investor is not a philanthropist. They expect business growth and a return on their investment. Second, we are not looking for a sponsor, we are looking for a co-owner. This should be a person or organization who shares your values, vision, and is ready to overcome challenges together with you. And third, fundraising is not a one-time meeting. It's a long cycle of building trust. From the first introduction to the final signature, it may take several months or more. In this process, it's important to maintain consistency, openness, and a willingness to listen. Remember, money is just one of the resources. In fact, you are building a support network around your business. Once you've defined your investment approach, it's important to understand that fundraising is not a one-time action. It's a step-by-step process. And the more complex the investment, the more structured this process should be. On this slide, you can see the 7 key stages of fundraising. The first step is preparing the strategy. At this stage, you define how much money you need to raise, under what conditions, for what goals, and within what time frame. You form a vision of how exactly the investors can help increase the value of the business. The second stage is preparing the materials. This means creating an investment package, a pitch deck, a one-pager, financial models, and preparing answers to typical investor questions. The third stage is searching for and qualifying investors. You make a list of potential investors who are interested in your industry, the stage of your startup, the type of product. It's important not just to find contacts, but also to assess relevance, how well you match each other. Next comes networking and initial meetings. This is about establishing connection, forming the first impression, and checking mutual interest. Here it's important not to sell, but communicate as partners. The fifth step is pitching. This is your business presentation. Brief, clear, convincing. This is the moment to convey your vision, the potential for scaling, and the expertise of your team. The sixth is negotiating terms. If the investor is interested, negotiations begin. The amount, the structure of the deal, the equity share, control mechanisms. And finally, closing the deal. This is the signing of documents, legal formalities, transfer of funds, and the official start of your collaboration. This process can take weeks or even months, but it's through this process that you not only raise funds, but form a high-quality partnership that can scale your business. After establishing contact with investors, the next critical stage begins: pitching. This is the moment when you have literally a few minutes to convince a potential investor of the value of your project. The key tool at this stage is the pitch deck, a short, structured presentation that opens the dialogue about investment. Its goal is to provide a clear understanding of the startup, the team, and the potential, to spark interest and to invite the investor to the next conversation. A pitch deck is not just a set of slides. It's a concise story about what exactly you are creating and what problem you are solving, for whom, who your users and customers are, why it matters and how you differ from other solutions on the market, how you'll make money, what your business model is, why you need investment, and how exactly you plan to use it. A successful pitch deck combines concise text, visual clarity, and persuasive logic. Its goal is not to instantly sell the startup, but to generate interest for a personal meeting. When we talk about the pitch deck, it's important to understand that investors evaluate not only the idea itself, but also how clearly, logically, and structurally you present it. On the slide, the classic structure of a basic pitch deck. Most successful startups follow it when preparing a presentation for investors. Let's start from the beginning. To capture the investor's interest, you need to show that you are solving a real, painful, and large-scale problem. Formulate it simply and clearly. Who it affects, how severe it is, and why it needs to be solved right now. Once the problem is defined, it's logical to move on to how you solve it. Describe exactly what you offer, your product or service. This should sound like a direct answer to the customer's pain point. But even the best solution doesn't matter without a market. That's why, next, analyze your potential customers. Describe who your users are, how many there are, and whether this segment is growing. A growing market is a major plus. With the market defined, it's time to show the product in action. Briefly demonstrate what your solution looks like. The interface, main features, prototype or demo. This visualizes your idea. Next comes the key question. How will you make money? Explain how revenue is generated, whether you already have early customers, and what your monetization strategy is. This helps the investor assess the commercial potential. Once it's clear what you are selling, it's important to explain how you'll scale. Which channels will you use to attract customers? Have you tested these hypotheses? Are there partnerships, paid ads, organic traffic? But a strategy is just a plan. The investor wants to know what has already been done. Provide specific figures, numbers of users, growth, partnership, testimonials. This confirms your ability to execute. Of course, the investor will ask, who else is in this market? Show who you see as competitors and what your advantage is. A clear map of the competitive landscape shows your maturity. Next, the team. Because people invest in people. Present the key members of the project. What are their strengths? What experience proves their ability to execute the idea? Now, the important block, finances. Present the key metrics, expenses, revenues, forecast, unit economics. These should be realistic, structured, and convincing. And only after all that your actual investment request. How much are you raising? For what period? How exactly will you use the funds? The investor needs to see that the money will be used rationally. Finally, close the presentation with a vision of the future. How will the product, company, or market change in 3 or 5 years? This creates an emotional ending and shows your ambition as a founder. Even the clearest presentation won't work if it doesn't spark an emotional response. Investors are not just analysts. First and foremost, they are people. They want to feel the team's energy, see sincerity, and sense that you can be trusted. That's why emotional connection often becomes the deciding factor. It's what switches on interest, builds trust, and motivates a deeper dive into the project. Yes, investors read numbers, they analyze markets, they evaluate business models, but the decision to invest is often made on a good level, on the inner conviction. These are the people I want to give my money to. That's why your presentation should not just inform, it should ignite. The investor needs to feel this team is driven, ambitious, trustworthy. This solution is not ordinary. This vision is inspiring. Investors often talk about this themselves, and it's very clearly expressed by Natalia Kushnerska, the director of the Ukrainian Startup Fund. She says, 80% of investment decisions are made emotionally. Investors often base their decisions on a personal liking for the team, its energy and charisma. That's why it's important to focus not only on logic, but also on sincerity and clarity of delivery. Your pitch must be structured, concise, without unnecessary detail, and at the same time alive. And the main question to keep in mind while preparing your pitch is, do they trust us? Do they feel our energy? Do we ourselves believe in what we are doing? Because that is exactly what infects the investor. Let's move on to the summary. We've covered the key aspects of attractive investment, from types of investors and mistakes in choosing them, to the essence of fundraising and the structure of a pitch deck. Now, a few main takeaways from this part of the lecture. Not every startup needs investment, and definitely not at every stage. Funding is a tool, not a goal. Investment without preparation can do more harm than good. If you're not ready to scale, it's better to postpone the fundraising. Fundraising is a process. It requires analysis, strategy, self-awareness, understanding your value, and the ability to communicate it to the investor. An investor is not just about money. A good investor brings expertise, a network of contacts, and reputation. And finally, the equality of your communication, transparency, and ability to build a dialogue often matter more than the numbers in Excel. This concludes our blog on the basics of startup investment. The road to investment is rarely a straight line, but every meeting, every pitch, every failure is experience that brings you closer to a breakthrough. Believe in your team, be honest in your communication, and don't be afraid to speak loudly about your dream, because that's how great businesses are born. Challenges lie ahead, but so do opportunities. And I truly believe for some of you, the first investment is just around the corner. Thank you for your attention, and I wish you success and inspiration.